We're going to begin with market positioning and comparing the official measures of market positioning with Onyx's own proprietary index. And for that, I'm going to turn to Harinder. So Harinder, can you tell us first and foremost, what were the more salient developments when it comes to the CFTC data, but also our own proprietary measure of CTAs when it comes to positioning, sort of from a broad perspective?
Absolutely, Harry. So to kick off with the CFTC data, the week to the 29th of July, we saw net positioning in the main exchange-traded futures for the managed money category pick up. So net positioning did increase. Again, with the more timely CTA data, if we take a look at the chart on the screen now, we see that although there was that increase in net positioning from the CFTC, in recent days, the positioning from CTAs has actually come off fairly considerably, down to levels into negative territory, effectively net positioning. And if we take a look at the next slide, where we see the predictions, we can see that across the exchange-traded futures, we have predicted even further decreases in net positioning, reflecting more bearish sentiment there, and quite considerable moves there. These are the units of these predictions are in lots, so decently.
Yeah. So between the CFTC and our own measure of the CTA positioning, has there been a contract that has really stood out in terms of movements or net changes?
Absolutely. So the two main contracts that come to mind would be the Brent futures and the ICE gasoil futures contracts. Those in the recent CFTC data in the week 29th of July, here we have the prompt gasoil futures. We see an increase in net positioning in the week, which contrasts to the CTA positions that we'll look into shortly. So the increase in net positions over the week took the long-short ratio from 3.9 to 1 to 4.1 to 1. Yeah. So that we can see here the significant pickup in the long-short ratio to levels not seen since July of 2024. Again, this contrasts quite considerably to the CTA positions, which we'll come to, where we predicted to see a lot more decreases in net length, relatively bearish for those contracts. If we take a look now at the CTA positions, direction, here we go. Absolutely. So yeah, so as you can see, the data that's more timely now, CTA predictions for today and for the following days are showing decreases across all the exchange-traded future contracts, and gasoil there you can see is following the trend. And if we take a look at the predictions, specifically the actual values, a big decrease visible there. And you can see here. So these are units of lots, so quite considerable decreases.
Okay, so I guess really the interesting thing is just in the past few days, we're looking at all the major energy contracts going into the red. Well, the data is interesting because it is like reported data, and in our case, predicted data for the CTA. We also have our own Onyx proprietary positioning index. And for those of our viewers who don't know, this is a modeled index where we look at various inputs to try to gauge where the positioning of the market is at. And that positioning is expressed as a deviation to an average level of positioning. So when we're pretty high on the index, we're overexposed, and when we're actually low on the index, we're underexposed. So, Harinder, when it comes to our own modeling of position, trying to step away from the data and try to capture the movement from a different angle, are we seeing anything particular, or are we actually seeing maybe something that really dovetails with the more recent data that we just looked at?
Absolutely. So the main few things that we've been seeing is a bit of a divergence between ICE gasoil heating oil and the crude contracts and gasoline. So the divergence that we're seeing there is that gasoil has been slightly more overpositioned, meaning that we've seen it closer to the higher bound of our score. So our scores are bounded between -50 and 50. 50 indicates overpositioning and -50 underpositioning. And the gasoil contract has seen levels closer to 50. I think on the 10th of July, we saw a score of 47, which indicates overpositioning, sort of concordant with the time that during the 12-day war and that period of time where there was obviously increased investment into risk assets, and gasoil specifically is a proxy for potential war. Since then, the contract has deleveraged considerably, and if we take a look at the chart on the screen here, you can see from that peak in early July at a score of around the 40s.
We're looking at the positioning as a dotted black line and the price action on the ICE gasoil contract as a blue line, right?
Exactly.
And they do match, fairly coincidentally, I would say.
Exactly, Harry. So you can see up there, that early July, that peak, we've seen prices come off, and now in recent days and recent weeks, there's also been that drop from the mid-30s down to a level of 17 current score, which is much closer to its average level of the past 3 years and more neutral territory. So that's what the bespoke our positioning index is telling us about gasoil, is that we're closer to neutral. We've seen this deleveraging, but there could still be further room to go before we get down to complete neutrality, that being a score of 0.
Right. Okay. And when it comes to our index, as I was mentioning, it is actually a composite of various signals we put into the model. Is there anything particular really driving gasoil in terms of the model inputs that has caught your attention? And are all the inputs actually behaving the same? Because once they start all going in the same direction, we may see further changes when it comes to price as a result of the change in positioning.